Hello viewers, I am CA Venugopal. Delighted to welcome you to the second video on GST Simplified series. In this video, we will understand on the input credit adjustment mechanism in GST. Like in most of my presentations, I emphasize technology plays a key role in GST. And likewise in today's session, we will also see the need of technology and its support in input credit adjustment. Firstly, I'll give you a glimpse of the tax liability and the input credits. Then we look on going how these adjustments happen. So let's start with a small case study on ABC Limited. So we will see the tax structures in GST for ABC Limited. So consider ABC Limited has their registered office in Karnataka. Now ABC Limited can have transactions with person outside India or person with a state, any other state outside Karnataka within India. Now it could be a factory, a trader, any SSE. So in this case, we consider there's a factory in Karnataka. Now the transactions that can happen within Karnataka would be with its own other branch office or a godown situated in Karnataka and not registered with another registration in GST. Now all these transactions with your own branch would be out of the purview of GST. Now there could be transactions with customers within Karnataka. Now these transactions would have output tax of GST, which would be CGST and SGST. You may also have transactions of purchase, which is inward supplies, with vendors in Karnataka. These transactions gives rise to input tax credit of CGST and SGST. Now the next set of transactions with customers or vendors outside India, be it on exports, which do not have any GST liability. Now with regards to imports, you would have IGST and customs duty. Now there could be transactions of ABC Limited with the persons situated in any other state outside Karnataka within India. Now it could be with your own godown branch warehouse situated outside Karnataka or with a customer outside Karnataka. There could be transactions of purchase with a vendor outside Karnataka. Now the transactions between the factory to customers and warehouse outside Karnataka would have IGST liability. Any materials that are purchased from the vendors outside Karnataka would have IGST input tax credit. Now, there could be various situations where a user can have all the purchases or materials as import, which will give rise to IGST credit. Now, the SSE can make sales only in Karnataka. So the entire liability is only CGST and SGST. It could be other way. All the purchases are within the state, which is CGST and SGST, and all the sales are to customers outside Karnataka, so which will give rise to only IGST liability. So there could be various situations where you would have liability under one account and input credits in another account. So let's look at what is the input credit mechanism in GST. Now we will begin with the CGST input tax credit which is available. Now CGST input tax credit has to be adjusted against CGST output liability only. If the liability is adjusted and still you are left with CGST input tax credit, then the differential, the balance input credit can be used to IGST output liability. Coming to SGST input tax credit, even SGST input tax credit first has to be used to SGST output liability. After using it, whatever is the input credit which is left can be used against IGST output liability. When it comes to IGST input tax credit, the first option of adjusting input tax credit is to IGST output liability. After using the IGST output liability, whatever the credit which is left can be first used to CGST output liability. Even after using to CGST output liability, if there is any amount of IGST input credit left, only then it can be used for SGST output liability. So friends, this is a mechanism using which the input credit adjustments happen in GST. So now you might be clear that the technology is essence in making all these kind of adjustments. So I would like to conclude stating that the automation is key to success of GST implementation. Thank you very much for watching this video.